All right, so far we've talked about cash value accumulation contracts and what makes them unique. We've also talked about why the New York Times calls private equity banking the secret of the affluent and how it protects the affluent. We've also discussed then 2 steps to using private equity banking: 1, getting out of debt, and 2, becoming your own banker. Now I want to give you some real-life examples of how private equity banking works in other people's lives. Now, these are real people that I've worked with. Obviously, I'm not going to share their names with you, but I'll be able to explain the story so you can see how these would fit into the lives of many of us. You'll recall that this all began because Mike told me he wasn't a real fan of whole life insurance, and I wrote back and said, I'm not either. Here's why. Most whole life insurance is based around death benefit. That's what it focuses on. In fact, it's called the base. And in most policies, that's 95% of the policy. So the majority share of what you've got is death benefit, right? And then a little bit of it is cash value, usually about 5%, so a very small portion of it. That's why I don't like whole life, and that's why most people aren't a fan of it. It also will come with restrictions. So from 5 to 15 years out, if you try to pull any of the cash value out of your policy, the restrictions and the penalties are so strong that it doesn't make any sense. And that's why most people do not like typical whole life. But we're not talking typical whole life here. We're talking about a private equity banking contract or a high cash value product. And with these, they are properly structured. When I say properly structured, 1 in 1,000 insurance agents even knows how to structure them. But a properly structured accumulation contract is about, let's say, 15 to 30% base, much less than the other. And then 70 to 85% of it, depending on what your needs are, is cash value. And so really you are creating the essence of a bank. It comes with guarantees of compounded interest. It grows, it's flexible, it's safe, right? It also provides dividends. I haven't talked about this yet because I've only talked about the guaranteed side. So your interest rate is guaranteed, the dividends are not. They typically run with good companies anywhere between 0.5 point and 1 point, but again, it depends on the company and your goals. Aside from dividends, you also have 0 early withdrawal penalties. So you can put your money in and 10 days later, borrow it back out and start using it, right? And then most importantly, they're tax-free. Again, back to what Ed Slott said, you're moving your money from an always taxed environment to a never taxed environment. And that's what makes these policies so special. So there are probably going to be about 4 different kinds of individuals that you will run into that need these policies. The first one is your W-2 employee, right? Back to that quadrant that Robert Kiyosaki spoke about, the top one being an employee. Then the next one are the self-employed, your doctors, your lawyers, your engineers. Now, a lot of these, it still says, you'll note that it says there, debt elimination. Why? Because a lot of these folks have a lot of debt from school and or equipment. I know my dentist is paying a ton of money on the equipment that he's got in his office. He's a young dentist. And so we've talked about these policies with him for that very reason. The next group are your business owners. And I love working with business owners. Why? Because you can smooth out cash flow. You can provide them key person insurance policies. When I say smooth out cash flow, by the way, what I'm talking about there is like, think seasonality. You know, somebody that clears snow isn't going to make much money in the summer, right? And somebody that sells solar panels isn't going to make a ton of money in the winter. So you've got seasonality or holidays when people make a lot more money. What these policies can do from a cash flow standpoint is help even out their cash flow. Even though they bring in a ton during the summer and then nothing in the winter, they can even that out so that they don't have to let go of employees during the winter. Because obviously, a solar company doesn't want to let go of all their electricians just because it's January, right? And then rehire them in March. That doesn't make sense. So it's a way of evening that out. And then the last one would be just the big, huge accumulation policies for the net worth, people of high net worth, the investors. Again, the 4 quadrants that Robert Kiyosaki talks about: employee, self-employed, business owner, and investors. So let's look at a typical debt elimination. This is just your typical American here. Notice that she has a bunch of credit cards, a timeshare, an auto, a truck, A lot of different things there, right? And there's the minimum payments that she's paying, and there's the actual payments. Well, the other thing that we want to look at is the overages that she is paying. I'm showing you how we structure these policies also, by the way. So you'll note that her actual payments come to $3,358 per month, but she overpays about $280 a month, and she and her husband are putting $170 into savings, which basically means we're going to be able to redirect inefficient funds to the tune of $450. Remember the question I asked at the beginning. If I could help you get out of debt in less than 9 years, without spending any more money than you're currently spending, would you do it if you could, right? And that's what we're talking about here, is finding inefficient dollars. And so that's one of the things that we do for you or your clients, is to find those inefficient dollars, and we're building a policy based on that dollar figure. Again, very different than a typical whole life insurance policy, because a whole life insurance policy, they look at how much death benefit you can afford and then tell you this is what you need to pay. Here we say, where's your inefficient dollars? And we're going to build a policy based around that figure, and whatever the death benefit is, whatever the death benefit is, because we're not really concerned about the death benefit at all. What we're really concerned about is the ability to have leverage and arbitrage to get someone out of debt. Okay, so in this woman's case, again, she's married, but we're using her because she was a little younger and she's a little healthier. So $450 a month is what we're going to put into this policy. Now, this is an example of the software that we've got. And you'll note here it shows us who the lenders are. Now, I don't need account numbers to do this, by the way, ever, with anybody. So just don't think you ever need that. You know, I need to know, excuse me, I say what those accounts are, Synchrony, Capital One, etc., so that I can keep them straight, but I don't need account numbers. I need to know what those accounts are, right? And then what our software is going to do is show the year and the date when they're going to be able to pay that off. Also, it's showing us the interest rate that this woman was paying. 29.9, 25, 35%. These are some pretty hefty credit cards that she's got, right? Then it shows the total amount of principal and interest that she owes. Well, no, it shows the total amount of principal that she owes right now. It doesn't show the amount of interest. We're going to add that to it so she can see it. And then what the minimum monthly payment is. And then we also have here the payoff amount. Now, notice on that first one, the balance is $1,000, but the payoff is $814. That's because it's going to take us about 4 months to get to the point where we can pay that one off. And so by then, she's going to continue to make her minimum payments, and she'll only owe $814. And then the last one, and this is the column that's so important to us, is the roll-up amount. So once we pay off that first card, we've got an extra $70 there for her. But when we pay off that second debt, now we've got an extra $357. And after that, the next one, now we've got $422 going toward paying down her debts. And that's what makes this so powerful. But again, back to how we structure a policy, $450. So her total payment a month in debt service will not change. It's going to remain the same, $3,808. Her minimum payments plus the $450 that she was overpaying or not using wisely, and we're going to put that into this policy for a total debt service of $3,808, and that's never going to need to increase for her to get out of debt in 8.5 years. Think about that. We're going to take this family from 25 years of debt down to 8.5. All right, so let's walk through this step by step. In month one, remember, it's a policy for $450. Some of it's buying what's called cost of insurance, obviously. I mean, there's still a death benefit. This is still an insurance policy. So I'm going to say that there's about $400 available to her and the accumulation contract that she could borrow against in month one, not the whole $450. Even so, she's still going to be able to wipe out $311,000 worth of debt in just 8.5 years. So in month four, notice that she has $1,120 available to her in her accumulation contract that she could borrow from. And she's going to be earning 4% on that policy, same as my contract. So that's $45. Now, the payoff for that first Synchrony card is $814. You with me? And she's going to have to pay $2,476 for the use of that funds. And that's going to cost her $39 a year, right? So she's going to make 45, she's going to spend 39, and you're thinking, $6 whole, Eric? You made me watch this whole thing just to get $6 in savings? No, it grows a whole lot bigger than that. But that is the arbitrage on the very first card. But note, that balance used to be $1,000 and that interest rate was nearly 30%. And we just wiped that out. So what she didn't have to pay this year was $814 at 0.299, right? The nearly 30%. That saves her $243. So when you take the $243 that she saved by not having to pay it to Synchrony, and you subtract the $39 that she did have to pay the insurance company, she comes out with a total of $204. So she saved $204, but she also saved a ton of interest on that card, and that's the reason why. Okay, so now let's move it out to month 13. Let's say she's paid off 4 of these things, right? She now has a cash value in her account of $3,685. And once again, that is guaranteed at 4% interest. So she's going to make $147 that year on that portion of her cash value. Her payoff for the 4th card is $1,687. And she's going to have to pay 0.0476 on that, or $80 in interest. The difference there, $67. You with me? But now look at this roll up. Now we have $598 plus the $450 that we're putting in. That's $1,048 that she's using and freed up now every single month to go toward her debts. What if we move it out to year 2.5, right? 2.5 years into this now, she has $1,812 of liquidity that she's paying against her debts. You see how this is a snowball on steroids? She's going to be able to get out of debt quicker because she's used this method. And this is only in 2.5 years. She's freed up $1,800. Remember, her total debt service a month when she began this was $3,358. And she's just freed up in 2.5 years $1,800 of liquid cash per month that she can do with as she please. In this scenario, we're saying that she's putting it against her debts because that's her goal, but we've still freed that up for her. That's, more than half of what she was spending on debt. All right, so let's look at this in another way. If she had continued to do what the bank had her doing, she would not have been out of debt for 25 years. And when she did get out of debt, guess where she's at? The big goose egg, $0. She's got no money. So she spent $553,000 in getting out of debt, in debt service over 25 years, right? Only to get her back to $0. Whereas using our method in 8.5 years, she paid off $311,000 worth of debt. And she's also freed up now at 8.5 years, $3,808 a month in liquid cash. That comes to $45,696 a year without getting a raise at her job. She has access to $45,000 more per year without changing jobs, only paying off debt in 8.5 years. And at the end of the 25-year period, she would have, if she continues to put that $3,800 into this savings account, and obviously she probably won't. She'll use some to increase lifestyle. She'll put some into an investment place. But if she continued to just put it into this savings environment, she'd end up with $913,000 in equity at the end of that 25-year period. Here's the interesting thing I haven't told you yet. This woman started at age 52. No spring chicken, right? Don't let her hear me say that. But she's as old as I am, right? She's 53 years old at the end of the first year. This is not somebody that's 25 or 35 years old. I'm not using an example of a perfect person, right? I'm talking about somebody who's already over 50 years old, starting at age 53, only putting in $450 a month or $5,400 a year in premium. Now, I want you to note over here where it talks about the annual liquidity. Notice how it goes up and down, right? For the first 9 years. That's because we're borrowing money, we're putting it in, we're taking it out. So the liquidity goes up and down. But then after that 8th year, 8.5 years, what ends up happening? She has zero debt. And as I just stated, she's got $3,800 more in cash available to her on a monthly basis. Now at age 65, again, she starts at age 53, now at age 65, only 13 years later, she's still at zero debt, and now she's got $228,000 in cash. Again, how far can we stretch this? She started at 53. If we go to age, well, and remember her normal debt, her home, she wasn't going to pay it off for 25 years. And now we're only stretching this out 18 years to when she's age 70. She's still completely out of debt, and she has $500,000 in cash. Starting at age 52, putting in $450 a month, we redirected inefficient dollars. Not bad for a savings account. All right, here's an engineer. This friend of mine had a Lowe's card, an auto, a city card, 2 houses, one's an investment property and one was a home, and a solar loan. $690,000 in debt, 29.7 years to get out of debt. And when you ask somebody like this, what's your total debt? They're going to know that it's the 690-ish, right? They can add up the mortgage. But what they don't add up is the extra interest they're paying. In this guy's case, an extra $526,000. So his real debt, total debt, if you just look at the numbers, 690. But if you look at the total debt, including the interest payments, if paid over 29.7 years, $1.2 million. We were able to help this engineer pay this whole thing off in 9.3 years. Saving $332,000 in interest. And this engineer was about the same age as that other person. So liquidity at the end of 30 years, $2.2 million. Death benefit and the liquidity comes to $2.7 million. This is the kind of policy, this was done on $60,000 a year. So that's a $5,000 a month policy. And this gentleman, when I talked to him, our first thoughts were about getting a policy that was only about $700 or $800 a month. But again, he was an engineer, and he went home and he thought about it after we talked about it, and he came back and goes, I shouldn't have $700 a month. I should be putting in like $8,000 or $9,000 a month. Okay, hold on, cowboy. Let's ratchet that back. And we ended up doing about $5,000 a month. And by the way, this is flexible. So although he started it at $5,000, he's been able to ratchet it down or up depending on what his monthly needs were moving forward. I can go into that in more depth with any of you individually. But just because he picked $60,000 a year doesn't mean he's obligated to it. He can ratchet that down a long way. But pretty good for a savings account on steroids. All right, now this one's a business owner example. This is a husband and wife. This happens to be the policy we wrote on the wife. And she's 57 when we wrote the policy, 58 at the end of the first year. And she and her husband were ready to retire. They had owned a retail store for about 30 years. A couple years back, they had the opportunity to purchase some real estate in a very good location for their business, right? And so they left the contract that they were with in a strip mall and they moved into their own property. But that incurred a pretty large chunk of money to get themselves this brand new building in this wonderful location. And so 5 years after they've got this new location, they decide that they're ready to retire, which incurs more expenses, right? They've got to hire a general manager and some assistant managers to take their places, right? And so I was over at their home and they were discussing all of this, and they were concerned because they had enough money in the bank to pay off the mortgage, but if they did that, they were, getting rid of their cash flow. Yet at the same time, they didn't like where their money was sitting because it was sitting in a volatile market-based account, and they were worried that something would happen to the market and then they'd lose that, and then they couldn't pay off the mortgage. So you see the conundrum they were in? And I said, well, you guys can get the best of two worlds. You could start an accumulation contract and put, say, $165,000 into it the first year, and then 13 months later, right, because it's a 2-year thing, so the second, at the anniversary of the first year, so in month 13, they could put another $125,000 into it, and then as soon as that money clears, they can borrow it. So, a couple days later, they can borrow that back and pay off their mortgage. And that's what they did. And you know what happened? They were able to pay that off in October. And what happened 4 months later? COVID hit. And what happened to their business last year? It didn't go as well as had been planned. And because the business is still paying them rent for the building, that's because they own the building in a separate entity, so the business is still paying them rent for the right to use this building that they've now paid off. Well, they struggled during COVID. And luckily, they had their mortgage paid off, and even though they had a loan out from the Legal Reserve Insurance Company, they didn't have to make any payments because it was a non-structured payment. Now the company's back up on its feet. They're back to normal. Things are getting better. But that was what they were trying to prevent, and it's exactly what they were able to prevent. Now, you'll note on there, too, that it says payments of $40,000 between years 3 and 7. Those are what I call phantom payments, and they're paid out of the interest that is paid on the policy. So really they only made 2 payments, $165,000, $125,000, and then all those $40,000 payments come directly out of the account itself. But for IRS purposes, they have to run at least 7 years. Again, we can go into that in detail later. But this was what we call a 2-pay, 1 month 1, 1 month 13, and then after that they don't have to make any payments. They were then able to purchase or borrow what they needed, over $200,000, to pay off their mortgage, and that's what freed them up. So one of the reasons I love working with business owners with these policies is that they've got quick access to capital. So, as we know, opportunities come along as a business person and you want to buy something or, whatever, and you've got access to instant cash if you've got these. You don't have to run to the bank and hope that they'll give you the money so that you could invest in something that comes along. There's no credit checks, right? Again, you don't have to go to the bank and show them your P&Ls and beg them for money. You've got the cash in an account that's yours. All you have to do is say, I want it. The insurance company doesn't ask what you're using it for. Smooth out the cash flow. I already talked about that, the seasonality issues. Again, as I just explained with this couple, it's an unstructured payment back. So even though they borrowed the money to pay off their building to the mortgage company, and their business was still paying them rent for the building, and they were taking that rent money each month and paying it back to the insurance company, when things went hard during COVID, they didn't have to make those payments if they didn't want to. So again, it's an unstructured repayment. You can save businesses tens of thousands of dollars, and you can also protect the company against economic losses like I just explained with COVID. This is a $1 million key person contract. This was a number of siblings. So they bought key person contracts so that if one of the siblings passed away, their spouse could buy out their portion of the company. So anyhow, again, we build these things for the person as they need them. It's customized to you and your family. It's not a one-size-fits-all. Here's another policy. This is an investor policy. These investors wanted to be able to get his cash out as quickly as possible to go use that cash again in a business environment. As the owner of this policy said to me, I make a whole lot more than 4% investing my money in other businesses and starting other businesses. Absolutely. But this gave them a place to put the money, take it out, borrow it, use it to build another business, pay it back, etc. And so that should give you some ideas on how these are done. Again, this is a 2-pay, 2 $1 million payments, year 1 and year 2. And this is what they had available to them in year 2, $1.9 million available to them, and a $25 million death benefit. Just to recap, what private equity banking does for you is it gives you a better system for debt elimination. It's a good place to grow and protect your money. It gives you a known future instead of an unknown future, i.e. it's predictable with guarantees. You have no risk, which brings peace of mind. And then you're able to create generational wealth and maintain generational wealth. The Morgans and the Rockefellers are proof positive of this. That's why you don't hear about the Vanderbilts, right, as much as you do the Rockefellers and the Morgans. Why? Because they were able to preserve their wealth. Again, my name is Eric Martineau. My wife and I, would either one of us be able to help you, or get a hold of anybody at the insurance team and we can help you out to structure one of these policies. If you're interested, kind of like the real estate thing, where we've got real estate agents now working at Nexa. If you're interested in learning how you could do this for your clients yourself, get a hold of me and I'll help you out with that too. So private equity banking, it is very powerful and it's something that can help you and your clients. Look forward to helping you soon.